Market volatility has been strangled in 2019, and a good chunk of the reason is central bank policy, with central banks committed to unprecedented levels of monetary policy accommodation, and all of the major central banks shadowing the Fed's every move. There's no longer any need for currencies to be jumping around. After all, currencies jump around on the game of interest rate differential speculation, and right now that game is dead. Look no further than euro-dollar, the most actively traded currency pair, where volatility has sunk to record lows. If we look at the average monthly range for this pair, we've dropped down to below 300 pips of range over the course of a month, this cut in half from the longer run average. Today, we'll take in the Fed's final policy decision of the year, and market participants will be looking for hints of any change in the trajectory that might point to some form of a pickup in volatility. Of course, if we take the glass half full approach, the good news is that with volatility where it is, the next big move is going to be a move back to the top side. At this stage in the game, believe it or not, it's unclear which way the Fed leans next. While there is no expectation the Fed will make any moves on rates today, the Fed is in position where it could still be pressured more by the market to slant further in the direction of policy accommodation, something that would once again call into question the Fed's credibility when it comes to defining the current period as a mid-cycle adjustment. This could be reflected in a dot plot that calls for more rate cuts looking out, or some commentary that calls for higher inflation as a prerequisite for the next rate hike. On the other hand, financial stability risk is becoming a serious concern, and with asset prices where they are and very little in the way of any new policy easing tricks up the Fed's sleeve, the central bank may want to get back to living up to that mid-cycle adjustment line, especially with economic data suggesting rates should no longer be as depressed as they've been. But it does all seem like we're getting to a point in this game where something's got to give, and when things give, everything becomes a lot more difficult to predict, which makes for happy days for currency traders starved for volatility. Breaking down today's decision, after 3 consecutive rate cuts, the broad consensus is for the Fed to remain on hold today. Fed members have made it clear that policy is appropriate, and they want to sit back and wait to see how things play out. Remember, the Fed did remove a layer of easing bias at last meeting, and with nothing really changing since, it would be hard to see the Fed changing course in the monetary policy statement. Again, the big focus for today should be on that dot plot. That's all for now.